Hi everyone, my name is Shillyboy Mothiba. I'm from Intergen. I'm a co-founder at Intergen and I'm a head of tax. It's my privilege to be having a conversation with you today. And basically, my being here, I just want to touch on how the tax efficiency on your structures, on your journey as property investors link up with asset protection. So I'm going to give various case studies for those that might be quite slightly understandable, having been exposed to it, it's okay. And for those that might be something new, you'll also learn something from that. And those who might be knowing, it's actually a refreshing of the memory. So now, let's take a step back, right? How do you actually, the issue of asset protection come into play? You basically protecting your assets so that you don't lose your wealth. And typically, how we end up losing wealth, we normally lose wealth from various things, and tax is one of them. If you don't get to the point where you structure your affairs or you administer your affairs in a more efficient or in a more tax efficient way, you're most likely going to lose wealth. And that's precisely where asset protection and tax efficiency kind of find each other. Now, let's talk in a situation where scenario number one, give it to somebody who has a trust for that matter, right? Now, what are your responsibilities or rather obligations when it comes to trust? Now, let's start with that. Once the trust is registered, right, to make sure that you administer from the tax point of view, you administer your trust in a more efficient way so that you don't end up being in a situation where you lose the wealth that has been structured under the trust. Because we can all agree that in the current sort of legal framework in South Africa, trust is one of the best tools that can be used to utilize there to protect your wealth. But however, how do we then administer from tax point of view to ensure that we don't lose the wealth? Now, number one, you need to make sure that once the trust is registered, it's obligation that it needs to be registered with SARS for the tax number. Most of people don't do that. That's indicator number one. Number two, because also those who might have actually been registered for tax number, they are not aware that by default, a trust is actually what we call a provisional taxpayer. What does it mean to you as a property investor when your trust, where you're creating wealth, is actually a provisional taxpayer? Which means that a trust is supposed to actually submit provisional tax returns every 6 months. In August, 28 February, or rather in a year where February ends it on the 29th of February, and the third provisional tax payment, which happens on the 30th of September. So think about a scenario where you don't do all those things. What could potentially happen to you as a property investor? Let's say, God forbid, it happens that you don't do all those things. You don't submit a provisional taxpayer. You are not even, for that matter, registered you didn't register your trust for tax number. Let's say you pass away during that journey. You didn't do all those things and you passed away. And you have been actually been generating some sort of income from the trust, right? Meaning that you have not actually structuring your things or you have not been run your things in a more tax efficient way. Then what happens? In that case, because we know that to be able to wind up your deceased estate, we still need to go through the SARS. SARS, if it picks up that, which most likely they're going to pick up, because before you can wind up the deceased estate, SARS needs to say, okay, Mr. So-and-so, your affairs are sorted from tax point of view. So if they pick up that you have been getting some sort of incomes as a beneficiary of that trust, they're going to say, hang on, which trust is this? And then they'll dig into that trust. Once they dig into that trust, what happens? The trust doesn't have a tax number. The trust has not been submitting provisional taxpayer, which can be what? Then they can pull the legislation on you. They can come and say, hang on, this trust actually, there was no separation between this founder and the trust, which means under the Estate Duty Act, because remember you had passed away during that time, they can come and say, this person actually, this disease had the powers to actually dispose this property. They can invoke Estate Duty Act, which means that you will be subjected to an estate duty tax upon your death. Can you imagine how much wealth you're going to lose? And that's precisely asset protection. You're going to lose wealth because if, for argument's sake, your wealth is below 30 million, it means 20% of those assets that are sitting in a trust, boom, you have to pay estate duty tax. And remember also, when you pass away, it's considered to have sold all your assets, meaning that it triggers capital gain tax. Think about it. Those assets that now are sitting in a trust, now you have to pay capital gain tax just because you did not register your trust for tax number, you did not submit tax returns, it becomes an issue. So that's what I wanted to show you guys from the tax point of view when it relates to trust, how small things that look so slightly that can actually even be outsourced to any if companies like Intergen, for that matter, that can do your tax returns and also submit your provisional tax returns and make sure that your trust has the tax numbers. You could have avoided, but you can end up losing up to 50% of your wealth just because you did not actually administer things in a more tax efficient, which links up to your asset protection, which meaning that you actually, by not doing these tax submissions, you actually did not protect your wealth. So that's scenario number one, where I just wanted to paint the picture that you should not actually be doing that. So for those who might be having trust, please make sure that your affairs are administered in a more tax efficient way. So the second scenario that I need to have a conversation with you guys, that I see that most people actually are making mistakes, and also links up with to do with asset protection. Now, this refers to a famous Section 13(6). Most property investors, they get very excited, but I found that most of you do not actually understand or you sort of misread Section 13(6). What is Section 13(6)? Section 13(6) is one of the capital allowance provisions within the Income Tax Act that a property owner, or let me rather use the wording in as per legislation, it says a taxpayer, they can be eligible to actually claim Section 13(6), provided certain provisions are met. And I'm going to unpack those provisions, right? Who is a taxpayer? A taxpayer can be a natural person. For those who still making mistake of buying properties in their personal names, can actually be considered a taxpayer. And a trust can be a taxpayer, and a company can be a taxpayer. I think let's deal with only these three scenarios. So that's provision number one, a taxpayer. Now that taxpayer needs to be owning at least 5 residential units. This is where most of you guys get it wrong. You are thinking that you need to own 5 new and unused. It says 5 residential units, right? That's a provision number 2. However, which is where the catch you need to understand, the deduction that you'll be allowed on that Section 36, it's related to new and unused residential units. This is where you guys kind of confuse the two. So meaning that for you to qualify, you don't necessarily need to be owning 5 residential units that are new. You need to be owning at least 5. So meaning that if it happens that you've got 6th one that is actually new, you're only going to claim on this one, which is the 6th one, right? But then the requirement is that you at least need to be owning 5 residential units. And this is the confusion that I needed to clarify. Now, it also further saying that any new unused improvements, you can have either new residential units or improvement. What is the improvement? Which is quite interesting because it has to do with also tax efficiency and asset protection. Some of you guys, especially you property investors who are in a multi-let, you might put in 2 or 3 more rooms in a structure. That's improvements. It enhances the value of that particular residential unit. So you are allowed to actually claim Section 13(6) in that improvements. And I think that's what is very important, right? Again, that improvement, most of you guys actually, because that's, again, asset protection. What is asset protection? If you remember what I said earlier, you protect your assets also by making sure that your tax affairs are actually efficient. That's how you protect your wealth. Now, on that improvements, most of you guys end up not even keeping those records of improvements. How are you going to claim from SARS? How are you going to claim your tax deductions if you don't even have? I've got a scenario actually where someone spent over 450,000 and they're about to sell this property, this residential unit. And I'm like, okay, fine. We can claim this 450,000 as a base cost so that we reduce the potential capital gain tax. But however, they don't have supporting documents for that improvements. You're not gonna claim it. What is that? You're losing wealth. You did not protect your assets in that regard, which is where your asset protection and tax efficiency kind of mismatch because you did not keep the records. So in that scenario, you need to be keeping this. Now let's go back to Section 13(6), which means if you meet all those provisions, then you are allowed for 5% deduction every year subsequent to that, right? So the 5% obviously is going to be, like I said, on that new unused improvements, or for that matter, on the new residential units. But it happens that you sell a property, and someone can say, what happens if I sell the property in the current year? What happens if, for that matter, I bring this property or these improvements in during the year? There's no apportionment. So meaning that you don't have to say, okay, I brought it only for 6 months of my year of assessment, then I need to apportion. No, you don't apportion it. It's precisely the whole year. You'll claim it at that 5%. Then again, like I said, that improvements, as much as you are claiming it on the capital allowance, is still capitalized on the base cost. Don't worry about that. It becomes technical. You just need to make sure that you keep records, and then we're going to claim it against the base cost should you dispose that property in the following years, maybe, 5 years later, for whatever reason you want to do that. So I think this is where, and it brings me also on the issue of base cost to say, what is this base cost that I'm referring to? Base cost basically it's a sort of a combination of a lot of costs that relate to that residential unit that you might have bought. It includes the original acquisition price, it includes those transfer costs, it includes the improvements, any improvements that you have done. And for those that might be advanced and also in a development, it might happen that your land is actually being, you're fighting for your land. Maybe there's an invasion and or maybe there's an issue or eviction. Those things you can capitalize because you are defending your rights towards the title of that property. So some of those costs, some of you guys who are more advanced as property investors, you might want to bear that in mind, that such costs actually you need to keep records of, because you can claim deductions against potential capital gain that you might generate as a result of selling your property at the later stage. So those are some two scenarios that I needed to have a conversation with you. So for that, thank you so much for having me. And yeah, I look forward to engaging with you. And yeah, you're welcome to reach out to us at Intergen. Thank you so much.